How much did you get to be the total assets, please? What the total assets? Yes. Was 26,400 plus 815 plus 21,600 plus that will be 6440 plus 5,000 plus 1440. So assets, here we have 55. This will be, what let's do with this. This will be 55, 255. Then let's come to this other side. Liabilities, we only have the creditors. We only have one liability there, which is the creditors. So the liability here is only these creditors, which is Ram and Sons. Ram and Sons. And this is 7,000. So get me the total here. How much are you getting? 5,000 minus 550 minus 1195. So we are going to have 5,000 minus 550 minus 1195 plus 7,000. How much are you getting? So here we have 55, 255. What's here you will get 48, 255. So 48, 255 plus 7,000, you get 55, 255. Are we on the same page?
Yes.
So now, this shows that we are very, very, very correct. How much are you getting on the asset side? Yes? You guys are lost or what? How much are you getting on the asset side? Yes? Welcome, Stacy. I hope you are following. Your assets total was how much? If you add 26,400 plus 850 plus 21,600 plus 5,000 plus 1440, how much are you getting? Yes, Millicent? Yes, guys. Sam, how much are you getting on the asset side? Yes?
Just a minute.
Ronald? How are you, Ronald?
I'm well.
55.
Yes? 55?
255.
That's asset, yeah? That's the asset side, isn't it?
I'm getting. Yes.
And then on the capital and liability side, how much are you getting as the total?
The same with the assets.
Very, very good. Now, that is where the secret lies. The balance sheet must always balance. The balance sheet side of the assets must always balance to the side of capital and liability. That's when the equation that I gave you, the equation of A is equal to C plus N will hold. So it means our answer is correct. And remember, where this question, we started with it from the journals. We prepared the journal, isn't it? We prepared the ledgers. We prepared the trial balance. And finally, we have prepared the profit and loss account and the balance sheet. That's where now the whole accounting bookwork ends. From journals, which is the which are the books of the original entry, where you enter data at the first point of entry. From there, you record them into what we call the ledgers. From the ledgers, we go to the trial balance. From the trial balance, we go to what we call financial statements. And your financial statements must balance. And to confirm that they are balancing, your assets must be equal to your profit, to your what? To your capital and liabilities. And that is what is here. So how much did we get as our assets? What's the total assets? Yes, Ronald? As per this question, what's the total assets?
55 to 55.
55 to 55. And our capital plus liability, which is capital and liability, which is this plus this. You get how much?
The same, 55 to 55.
55 to 55. Meaning this question is correct. Meaning we have done it correctly. Because our assets is equal to our capital and liabilities. And if you want to also confirm that your profit and loss statement is correct, can you see here, we added net loss. We brought here net loss. And remember, net loss came from the other statement. Net loss came from the statement of profit and loss. Net loss came from the statement of profit and loss. And we put it here. When we put it here, we got this figure. Then our debtors, our creditors, then it gave us the correct figure. This is how to test if you are correct. So in this case, if this was a question in the exam, you could have gotten the 20 marks. And for this thing to be correct, your trial balance must also balance. So anything that you see with the word balance in accounting, anything you see with the word appearing as balance, always that statement must be equal. All its elements must be equal to another element within the same statement. So when your trial balance balances, it means your books, which is statement of profit and loss and the balance sheet, will also balance. So this is how to go about the whole thing. So any question before we go to something else? I want us to go to something else. Yes. Yes, Ronald.
I was just requesting if you can give us a list of maybe the assets and liabilities.
Okay, I'll share. I'll give you examples, but there's no fixed list of assets. There's no fixed list of assets. You need to, to internalize this. Because tomorrow there might be something else that falls under the category of assets. But instead of asking me for a list, you should be able to understand, because we're the same of the cram list of assets. Something else might come, but I'll give an example that will help us understand how to identify an asset, a liability, and a capital. So that one will come to the one. So now, this is how to prepare a balance sheet or a statement of financial position for a mesh. Remember, this question had not asked us to prepare a statement of financial position. It had not asked us to prepare statement of profit and loss. But for you to be able to connect, I wanted you to be able to connect how to maneuver from the statement, from the journals to the ledgers to the trial balance, and finally to the statement. So the question had not asked us, but we have done it finally, and we have realized that it is balancing, meaning we have followed the procedures that are laid down in the process of preparing statement of profit and loss and statement of financial position. So I'll take a snap of this and share it with you for you to try and connect later when you're doing your revision. But remember, this is how to go about it. The other thing that I want to explain on this side, stock. Stock refers to items that are owned by the business for the purposes of doing business. So you must also remember that. And all these are current assets. Stock, because when we looked at this business, there was no land, there was no motor vehicle, there was no building. The only things that we were given were falling under the category of current assets. So stock is an asset, cash is an asset. Now, when we have cash, like for you, for example, if you have 50,000 in M-Pesa, that's an asset because it gives you power to buy whatever you want. That whose value is equivalent to 50,000. So it's an asset. So if you have money now of like 50,000 cash, that is an asset to you because it gives you the ability to buy whatever you want that 50,000 can buy. Then bank, when you see something mentioned as bank in accounting, it means money in the bank. Because you have money can be held in two ways. You can have money in two ways. You can have money in cash, or you can have money lying in the bank. So cash at bank is an asset. Then you have M&A company. This is a debtor. If someone owes you money, that's an asset because he's holding that money for you. When you want it, you will get it. Or when they are ready, they give it to you. So debtor is an asset. If someone comes to your shop and buys things on credit of 20,000, you will count that as an asset because your mind will be that so and so owes me money. So this M&A company is an asset. Chandler & Sons is also an asset because they owe this company. This other side was the capital and liability side. And we can see capital was 50,000. This is the money that the owners invested in the business. So this will remain. But this capital is affected by two things. Capital is affected by two things. Drawings, and we say the drawings is when owners of the business take out money from the business, or if they take goods from the business for personal use. So anything taken out of business for personal use, we call it drawings, and we must deduct it from capital. For example, if you start a shop now, and in that shop, you have unga and the rest. If you take unga from that shop to cook ugali to eat, that is drawing, because you are reducing the capital, you are reducing the stock that's in that business. Or if you go to the cash box for the business and you take 100 shillings, that should be counted as drawing. And all that will reduce your capital. That's why we are deducting this thing called drawing. Again, if the business makes losses, the loss should be deducted from capital. That's why we are deducting 1195 from the capital, so that we get the net capital. So these guys, their capital has reduced from 50,000 to 48,255 because of these two items. Then lastly, we had liabilities. And this person is a liability because they gave us goods, they gave business some goods to do business with, but this business has not paid. So we have to list them as creditors. So basically, that's what we refer to as preparation of financial statements. Any question? Any other question? Please. Before we do something else.
About the arrangement of the assets, you have stock and then cash and then the debtors coming after cash and bank. Is it supposed to be that way, or you can arrange in the order of permanently? Where you have stock.
You are not clear. Come up again, please. Be audible.
Okay, I have a question on the arrangement of assets.
Yes, Millicent.
Whereby we have stock, cash, and then bank, and then we go to debtors. Is it supposed to be from stock we go to debtors, and then cash, and then bank?
Oh, thank you for that question. There is no order. You can follow any order as long as the category in which you put your asset is appropriate. This one we can use any. This is not the order. you can use any order as long as you make sure that everything that you put under this category are either current assets or non-current assets. So hakuna order, you can put them anyhow. Is it okay, Millicent?
Yes, it's
Haina
okay.
mpangilio. Hii haina mpangilio yoyote. You can use any format. You can use any arrangement. Any can start as long as they are current assets or long-term assets. Is that okay?
I have a question.
Yes.
The debentures, where does it, or
There.
you will explain later in the topic?
Yes.
Debentures
Yeah.
and profit sharing ratios. That's where I have a problem.
Debentures.
Yes.
So you are asking about debentures and profit sharing ratio. That is
Yeah, like
Ronald,
for
yeah?
partnership.
That's Ronald.
Yes.
Yeah?
Yes.
Ronald, we'll come to that, but for now, we will come to that when we look at preparation of financial statements for a company, then I'll explain, yeah? But debenture is a long-term liability. Are you together?
Yes.
Debenture is a long-term liability. So when you are given a debenture, make sure you put it under long-term liability. Then profit sharing ratio will not appear anywhere. Profit sharing ratio will not fall anywhere in your financial statement. Profit sharing ratio will not fall anywhere. Are we together?
Yes.
So let's close that. I've shared this on your WhatsApp so we can move to something else. Let's move to something else. You want to move to another topic, but I want to give you the format of preparing these things. So just a minute, let me get you the format. So let me give you a format that will guide you forever and ever in preparation of financial statements. I'll share it on the screen so that we go through it together. So I want to give you the format on how to go about preparation of those statements. So allow me to share with you what will help us understand this. Okay, so we are there. I think you can see the note. Let me take you to the bit. Are you able to see this part that we have here, horizontal format of the statement of comprehensive income. Are you able to see that?
Yes.
Yes.
Yes. So now we have several formats, but the one that we normally use mainly is the horizontal format. The one that we normally use commonly is the horizontal format. So this is how it looks like. And I want to take you through so that when you meet this next time, you'll be able to understand. So we have there so we start with sales. So when you are preparing profit and loss account or statement of comprehensive income, like you can see here, you start with the name of the company, XYZ Limited. This should be XYZ Limited. Then under it, you write statement of comprehensive income. Then you put the period. So this should be 3 lines. So this XYZ Limited, then the next line should be statement of comprehensive income. Then the other line will be for the period ended this. Then you start with sales. So you get sales, you take sales, you put here the amount of sales, then net is less return inwards. One of you asked about return inwards. So once you get return inwards, you less it from sales. Remember, we said return inwards refers to those sales that we made but have been returned by the customers. So you'll have it here as return inwards. From there, you get net sales. Sales less return inwards to get net sales. Then from there, you now prepare what we call cost of sales. And cost of sales is given by opening stock. Then you add purchases. You add carriages. Again, someone asked about carriage inwards. And we say carriage inwards, you add it to sales, to purchases, sorry. So you add the two, then you get the total. Then again, you less return outwards. These are goods that were bought but returned. Then you get net purchases. From there, you get goods available for sale. Then you less closing stock, then you get cost of sales. Then it's from this cost of sales that we get here, you take net sales less cost of sales, you get what we call gross profit or loss. Here you get gross profit or loss. Then from there you add other incomes, which is here, other incomes, add other incomes, add other incomes. So other incomes are things such as discount received, profit on disposal of an asset, income from investment, then other incomes, e.g. interest received from bank. Then you get the total here. Then from the total income, you less expenses such as administrative expenses, operating expenses, selling and distribution expenses, then total expenses. Then from after deducting expenses, you are going to get net profit or loss for the period. So basically, this is the format of a profit and loss account or statement of comprehensive income. Then let's look at the format for the balance sheet toward the end of these notes. Balance sheet statement or statement of financial position. We have the format down here. You have these notes, so don't worry, you have these notes with you. For those who read, you'll find all this with you. So let's look at the format for the balance sheet. So statement of financial position, just as I had said, and you can see they have repeated the formula here. For you to be able to prepare a statement of financial position, you must apply this formula, which is assets is equal to capital plus liabilities. Then assets have been explained here, just as I had explained to you, these are the assets, explanation about assets, liabilities, all that, capital and all that. So this is the format for the balance sheet. So you start with the name of the company, XYZ Company Limited, statement of financial position as at means the end of the year that you're dealing with. And we said we have different types of assets. So we have non-current assets, that's what starts. A non-current asset, Ronald had asked about examples of assets. So here we've been given an example of the assets, though this is just the format. So we have land and building is an example of a non-current asset. Have plant and equipment. Plant and equipment. Plant is not the plant at ile mimea. Plant is not the green plant that you know, like trees, maize. No. In accounting, plant here stands for a factory, a building that is used to do business, such as manufacturing plant or factory. That's what we call a plant. A building with machines and everything that is used for business or manufacturing, we call it plant. So don't forget, don't be confused that this plant refers to the plant that you grow in the shamba. No. This is the plant in terms of asset, meaning it's a building like a factory. Equipment refers to machines. Land, you know what land is, and building, you know what building is. Then you less what? Accumulated depreciation. We will look at depreciation later in details. We'll look at depreciation in details later, but not now. Then you have fixtures, furniture, and fittings. Furniture, these are things like office furniture. Every office have got furniture, like such as desks, tables, cupboards, all those are assets. And they fall under fixed assets. So that's why we have them here. And then you know what fixtures are. Fixtures refer to things like shelves. If you go to a supermarket now, you see things such as shelves, you know, things that are fixed in an office or in a factory, you call them fixtures. From the word fixed, fixtures. Then you also depreciate them. Again, the other example of a non-current asset is motor vehicle. Also, you put them there. Then you get total current assets. Then total non-current assets. So then you get total, you go to current assets. Things such as stock, debtors, less provision for doubtful debts, those will be under current assets. Then you have prepayments. We'll talk about that one later. We have short-term investments. You have cash at hand, cash in hand, cash at bank, cash in hand, and then you have total current assets. Then less current liabilities. This one is another format, but use the one that I've shown you. So out of these, current assets, again, you can less current liabilities such as bank overdraft, creditors, and accruals. The net current assets will be getting it. Then we have capital, add net profit. You can, if it's a loss, you deduct. Then again, you less drawings. Then you will get net capital. Then non-current liabilities such as loans, you also add. So basically that's the format for the two, for the income statement and for the profit and for the balance sheet. Any question before we move to something else? Any question? Any question? So basically we are through with that topic 2. We are now getting into topic 3. Let me show you. Yes?
Can you just explain, I mean, the meaning of provision of doubtful debt?
The meaning of a?
Provision of doubtful debt.
Okay, now, thank you for that question. Your colleagues are not even asked. So when you talk of provision for doubtful debts, yeah? Now, when you talk of provision for doubtful debts, we refer to a percentage or an amount that is allocated for the debtors that are likely not to be paid. And it's normally good when we explain these things with an example. And I want you to be attentive. I want all of you to be very attentive so that we understand what we mean by doubtful debt. Now, when you say our debt is doubtful, we mean that that debt is not likely to be paid. For instance, if you have 20 people, let's say you have 20 people owing 100,000. You have 20 people owing you 100K. And they tell you they are going to pay you. Do you think all of them will end up paying you that money? Stacy, if you have these people owing you 100K, do you think at the end, watakulipa wote?
No.
Yes. No. Some will default. Some will disappear with your money and you forget. So in business, there's normally there's a concept. We are going to look at this thing. Our next topic is the concept. There's a concept called prudence. Prudence or conservatism. Conservatism. So now, when we talk of doubtful debts, the principle that guides the accountants to allocate a figure to doubtful debt is what we call prudence or conservatism, which we are going to look at the next topic. The next topic we are going to go into now is called accounting theory. It's the principles that guide the accounting work, the accounting profession. Now, when you have 20 people owing you 100K, there are chances that some of them will not pay. Reason being, some of them will be genuinely broke. Yeah. Some of them might die with your money. Where's the end of time might pesa? It is so inhuman. So you will just leave it. Some of them, due to bad habit, will just decide not to. Isn't it? Some of them will have lost jobs. Their circumstances will not allow them to pay. So you as Stacy or Sam or Ronald or Millicent, if you're in that situation and you want to be sure of the amount of money you are likely to be paid back out of 100K, you will do what we call provision for doubtful debts. You give a percentage of the amount of money that you are going to lose. So, Ronald, in your situation, if you are in this situation, how much do you think you are likely to get back from this? If there's 20 people owing you 100K, if you are in that situation, how many people do you think will pay you back? How much will you get back from this amount? Yes, Ronald. or Ronald left, you know, Simski bana. How much money do you think you'll get back out of this?
Say 18 people will pay.
18 people.
So it is 8.
Huh? Yes? Umesema wangapi?
16 people to pay.
How
16.
many?
16 people will pay, so it will be something
15
like
will pay. So according to Ronald, 15 will pay back. So now to get the provision, you take 15 out of 20 times 100K. How much are you in that? Yes? What is the percentage here? Or no. 15 out of 20 times 100. What's the percentage? Yes? Here 1. Here. This 15 by 5, you get how much?
75.
35, single.
By
So 35%. So according to Ronald,
75.
75.
75, yeah? So according to Ronald, 25% will not pay back. So now get me 25% of 100K. It's how much? Yes, 25,000. Sindio?
yes.
So according to Ronald, he's going to lose 25,000 as bad debt. So this 25,000 is what we call provision for doubtful debt. When you want it in percentage, it is 25%. Are you seeing that?
Yes.
Though this is ahead, as we continue with the learning, we are going to learn about this. But I wanted to bring to you to understand what we call provision for doubtful debt. Now, I've given an example with a real human example. Businesses also go through the same thing. Because businesses do business in terms of credit. So if you're doing your business in credit terms, that is, you give your goods to people and then they pay later. You do business in credit terms. There are people who are not going to pay. Now, to be sure that the debtors figure that you have in your balance sheet is correct, you do what we call provision for doubtful debts. And this is how we go about it. And you, let's say someone else has got a different perception. Stacy, how many people are, let's say, Stacy, you are in this situation. How many people are likely to pay you back your money? Yes?
Maybe 18. 18.
18.